Hello students, welcome to Accounting Explained at Accountwise Academy. This is Lata Venkateshwaran. This is the part 2 video of chapter 3 lesson of NCERT syllabus class 11 accountancy portion. So the chapter name is recording of transactions. If you want to look into the shorts and MCQs of this chapter, you can see our channel Accounting Explained at Accountwise Academy. I will be sharing the link of chapter 1 and chapter 2 lessons in the description box, and you can see the MCQs and short answers for the chapter 1 and chapter 2 in our channel. Topics to be covered for today's video are accounting equation or the balance sheet equation and the rules of debit and credit. Accounting equations. In the accounting equations, we are going to learn that assets is equal to liabilities plus capital. This is what we are going to learn. This is called as accounting equation. Accounting equation shows a fundamental truth. What is that? A business's assets always equals its liabilities plus owner's equity. That is liabilities plus owner's equity is what? Capital. So business assets can also be called as what the business owns, right? Yes, it can be called as what the business owns. And liabilities can be called as what it owes. That is the debt it owes to the outsiders. And owner's equity can be called as what's left after debts. That is the remaining of the liability, what is left after the debts with the outsiders. Okay, so we can rearrange the equation to find missing values, that is either capital or liabilities. If one of these values are missing, then we can easily find out by just tweaking the formula. Now when you take assets minus liabilities, we get capital. That is A minus L is equal to C, and assets minus capital equals liabilities. A minus C is equal to L. Either way you can find it out. This equation can also be called as balance sheet equation because it reflects the key components of balance sheet. What are the key components of balance sheet? They are the assets, liabilities and the capital. So this equation comprises of or includes assets, liabilities and capital. That is the key components of the balance sheet. They can also be called as the balance sheet equation. This equation ensures financial balance. Every business transaction affects the equation. So every business transaction you make, that will affect the equation. But the total of the assets, total assets will always be equal to the total liabilities. What is total liabilities? It is liabilities plus capital. Okay, that will always be same. Total assets and total liabilities should always be equal. Let us see a problem on accounting equations. Okay, this is a problem taken from your textbook. It's an example problem. Let's see how to solve this problem. The problem starts like this. Rohit started business with a capital of rupees 5 lakhs. So Rohit is starting a business with a capital of 5 lakhs. When you start a business, what will happen? With some amount your cash is going to be increased, and so you are bringing in capital. Obviously your capital is also going to be increased. So cash is what you own, that is your assets, and capital is what you owe to the owner, so that is your liabilities. Okay, so let us see how to solve. See here there are various columns. Transaction number is there, and cash is there, cash column is there, bank column is there, debtors is there, stock is there, furniture is there, plant and machinery is there, and total of assets. These are all what we own, right? So this is total assets. These are all the accounts which you are going to see when solving the problem. And on the right side we have liabilities, capital and total of liabilities. Okay, at any point of time, your total assets should always be equal to your total liabilities. Okay. So you have started a business with a capital of 5 lakhs. So your cash is increased by 5 lakhs and your capital is increased by 5 lakhs and you have a total assets of 5 lakhs, total liability of 5 lakhs. So your total assets is equal to total liabilities. So this is your initial transaction. From the next point, the actual transaction starts. Okay. So what is the next transaction? Open the bank account in State Bank of India with an amount of 4,80,000. You have opened a bank account. What will happen? From where you will bring the amount? You're going to bring the amount from your cash. So your cash is going to be reduced by 4,80,000. And from where you have put that amount? You've invested that amount or deposited that amount in bank. So your bank will increase by 4,80,000. What is the second transaction? Your cash is reduced by 4,80,000. See here, cash is reduced by 4,80,000 and your bank is increased by 4,80,000. Actually, the effect on the total asset is zero because 4,80,000 minus 4,80,000 is zero, right? So total assets remains the same, 5 lakhs. And capital also there is no change because of this transaction. It remains the same. And total as liabilities is 5 lakhs. Total asset is 5 lakhs. Next point, bought furniture. This is the second point. Bought furniture for rupees 60,000 and with a check was issued on the same day and the check was issued on the same day. So you bought furniture and check was issued. Check issued means the amount is being paid from the, yes, correct, bank. So your furniture is going to be increased by 60,000 and your bank is going to be reduced by 60,000. So this is the second transaction. See the second transaction. Okay. In the second transaction, bank is reduced by 60,000 and your furniture is increased by 60,000. Again, the effect is nil. 60,000 minus 60,000 is 0. So the total remains the same. See, cash is now has now become 20,000. Bank has now become 4,80,000 minus 60,000 is 4,20,000 and furniture is 60,000. When you total all these things together, you get rupees 5 lakhs and your capital is 5 lakhs. Total liabilities is 5 lakhs. So total liabilities is equal to the total assets. Okay. So the third transaction, let us go to the third transaction. Bought plant and machinery for the business for rupees 1,25,000 and an advance of 10,000 rupees in cash is paid to Messrs. Ramji Lal. So you bought plant and machinery. Plant and machinery for 1,25,000 is increased by 1,25,000 and an advance of 10,000 in cash is paid. So you have paid an advance of 10,000 rupees in cash. What will happen? Your cash will get reduced by 10,000 and the difference is there. Now how much is the difference? 1,25,000 minus 10,000. 1,15,000 is what you owe. That is your liability. So liability is going to be increased by rupees 1,25,000. Sorry, 1,15,000. That is 1,25,000 minus 10,000. So let us see how this happens. See transaction 3. So this is your third transaction. First minus 10,000 rupees you have paid as advance and 1,25,000 your plant and machinery has increased. Net effect is 1,15,000. Here your liability has increased by 1,15,000 and your capital, and this is the net effect 1,15,000. Now how the account changes, we'll see. Cash remains the same 10,000. Bank remains the same. Cash is reduced by 20,000 minus 10,000, that is 10,000. Okay, because you have paid advance in cash. Total now cash balance becomes 10,000 and your bank remains the same 4,20,000. Furniture is 60,000. Your plant and machinery has increased to 1,25,000. Total is 10,000 plus 4,20,000 plus 60,000 plus 1,25,000 is 6,15,000. Your liability has increased to 1,15,000. Total this is okay. Capital is 5 lakh. So total of liability is 6,15,000. Is it not tallying? Yes, it's tallying. Okay, next. Goods purchased from Messrs. Sumit Traders for 55,000. See, they have simply told they have purchased from Messrs. Sumit Traders. They haven't told whether they have paid by cash or they have paid by check. Nothing is mentioned. Then, if nothing is mentioned, we have to take it as they have bought it on credit. So, they have bought goods. Goods is nothing but your stock. Stock is increased by 55,000, and again since you have bought it on credit, what you owe is increased. That is your liability. Liability is also increased by 55,000. See here, your stock is increased by 55,000. Net effect is 55,000. Your liability is increased by 55,000. Net effect is 55,000. Total effect is cash remains the same as 10,000. Bank remains the same as 4,20,000. Now we have introduced a new account called stock, that is 55,000, and furniture everything remains the same 60,000, 1,25,000. When you total 10,000, 4,20,000 plus 55,000 plus 60,000 plus 1,25,000 is 6,70,000. Here your liability becomes 1,15,000 plus 55,000 is 1,70,000 plus 5 lakhs is 6,70,000. So total assets is equal to the total liability, which is 6,70,000. Okay. Next, goods costing rupees 25,000 sold to Rajani Enterprises for 35,000. So goods worth 25,000, they have sold it for 35,000. Worth of the goods is 25,000. Okay, they have sold it for 35,000. So they have made a profit of 10,000 rupees. Now they have made a profit of 10,000 rupees. Usually profit is added back to the capital account. Okay, because only the owners, they have invested in the business. Whatever the profit the business makes, that has to go to the owners. Correct. So it has to be added to the capital. What will happen now? Your stock, since you have sold goods, your stock is going to be reduced by 25,000 rupees. That is the stock cost of the goods, because you have taken the stock in the cost price. So you have to take only 25,000, and you have sold it for 35,000 rupees. Here again they have not mentioned whether they have sold it for cash or they have bought it for by check. Okay, they have sold it for cash or they have debtors are paid by check. Nothing they have mentioned. So we have to take that as they have sold it for credit. So the debtors is going to be increased. Stock is going to be increased by 25,000, and debtors is going to be increased by only the sale price. No, only that is the amount is outstanding from the debtors. So debtors is going to be increased by 35,000, and your capital is going to be increased by 10,000 rupees. That is the profit part. Here we saw, no, this profit part will be taken to the capital. So let's see, this is your 3, 4, fifth transaction. So fifth transaction, see the fifth transaction, your debtors is increased by 35,000. Your closing stock is reduced by 25,000. That is the cost price. And net effect is how much? 35,000 minus 25,000 is 10,000 rupees. And now the capital is increased by 10,000 because of the profit earned from the sale of the goods worth rupees 25,000 for 35,000 rupees. And the total liability net effect is 10,000. So the final is cash is 10,000, bank is 4,20,000, assets is 35,000, that is debtor, sorry, stock is 30,000, furniture is increased by 60,000. See, your furniture is increased by 60,000. Plant and machinery is increased by 1,25,000. Total assets now become 6,80,000. And liabilities is 1,70,000. Your capital has increased by 10,000 rupees after the last transaction. No profit we made from selling goods worth 25,000 for 35,000. So your capital becomes 5,10,000. Total liability is 6,80,000. Now we are going to transpose. this assets, cash, bank, data, stock, furniture, plant and machinery, and liabilities and capital to the balance sheet. And we will solve the accounting equation. So, balance sheet shows the financial position of a company or a business as on a particular date. See here, balance sheet asset that some date on 2017. Okay. On the left side is your liabilities, and on the right side is your assets. So there is another column for amount, and here also there is another column for amount. Totally there are four columns: liabilities, amount, assets, amount. So first we'll see the liabilities. What is a liability? Liabilities is 1,70,000. We have to take only the final amount. Okay. So liabilities is 1,70,000. That is outside is claim. What we owe creditors is 1,70,000. And capital is 5,10,000. Capital is 5,10,000. Now we'll see the asset one by one. Only the take the final amount. Okay. This amount only you have to take. Cash is 10,000 rupees. Bank is 4,20,000 rupees. As debtors is 35,000 rupees. Closing stock is 30,000 rupees. Furniture is 60,000 rupees. Plant and machinery is 1,25,000 rupees. And when you total on both the sides, it is 6,80,000. 6,80,000. So what is accounting equation? Accounting equation is equal to assets is equal to liabilities plus capital. So what is liabilities? Liabilities is first asset. How much is the asset? Asset is 6,80,000. Liability we will split. What is liability? That is creditors. What we owe? 1,70,000 plus. How much is the capital? 5,10,000. We are taking everything from your balance sheet. Okay. 5,20,000. When you total, you get 6,80,000 is equal to 6,80,000. So this is the accounting equation. Accountancy sits on the table of debit and credit. So we have to first understand what to debit and what to credit. Okay. So accounts can be divided into five major categories. What are they for the purpose of recording the transactions? What are they? Asset, liability, capital. These three things we saw. Expenses or losses and revenue or gains. These are the five major accounts or categories of transactions for recording the transactions. The fundamental rules are followed to record the changes in these accounts. So whenever there is changes in these five accounts, then we have to record it in our books of accounts. For recording changes in assets or expenses or losses, what is the rule? Increase in asset is debit and decrease in asset is credited or credit. Increase in expenses or loss is debited and decrease in expenses or losses is credited. So increase in asset and increase in expenses, they are debited. Similarly, decrease in asset and decrease in expenses or losses are credited. Okay. Next, for recording changes in liabilities and capitals or revenues or gains. Increase in liability is credited and decrease in liability is debited. Increase in capital is credited and decrease in capital is debited. Increase in revenue or gain is credited and decrease in revenue or gain is debited. So here all increase in liabilities, increase in capital and increase in revenue are credited. Similarly, decrease in liability, decrease in capital and decrease in revenue are debited. Okay. Rules of debit and credit. This tabular column I have taken from your textbook. See, there are six categories of accounts: assets, liabilities, capital, revenues or gains, and expenses and losses. Assets will have a debit balance. Similarly, expenses will have a debit balance. So when you are going to increase the debit balance, you have to debit it. Increase in asset means increase in the debit balance, you have to debit it. Decrease in the asset means you are going to decrease the debit balance. What is the opposite of debit? Credit. You have to credit the asset account. Okay. When you are going to decrease. Similarly, same. When you are going to increase the expenses, then you are going to increase the debit. So it has to be debited. When you are going to decrease expenses or losses, you are going to do the opposite of debit. What is the opposite of debit? That is, it has to be credited. Now let us see liabilities, capital, and revenues or gains. All these three accounts have credit balance. What these accounts have? Credit balance. Okay. So when you are going to increase the liabilities, when you are going to increase the capital, when you are going to increase the revenue or gains, you are going to increase the credit balance. So it has to be credited, credited, credited. Similarly, when you are going to decrease the cap liability, decrease the capital, and decrease the revenue or gains, what you are going to do? You are going to do the opposite of credit. That is, you are going to debit it. Debit the capital when it is decreased. Debit the liability when it is decreased. Debit the revenues or gains when it is decreased. Okay, so easy way to remember is assets and expenses or losses have debit balance. Increase in the assets or expenses or losses increase the debit balance, so it has to be debited. Decrease in the asset or expenses or losses, it has to be opposite of debit, then you have to credit it. Similarly, liabilities, capital, liabilities, capital, and revenues or gains have credit balance. So when you're going to increase, they all have the credit balance, right? So when you're going to increase the liabilities, capital, or revenues or gains, then you are going to credit it. Okay. When you're going to decrease the liabilities, capital, or revenues or gains, you are going to do the opposite of the credit. That is, you are going to debit it. You remember this, it will be very easy. Okay, only the balances if you have to remember. Sorry, assets, expenses or losses have debit balance. Liabilities, capital and revenues or gains have credit balance. That's all. Okay, remember this. You will be easy. It will be very easy to do the debit or credit properly without any mistake. With this, we are completing the part 2 video of chapter 3, recording of transactions, class 11 NCERT accountancy portion.